Good morning, everybody. All right, welcome back to the coffee hour. I just realized that I had done a previous video on dividend investing, so some of this might actually be a little bit of a rehash. I didn't really realize that until after I launched it. So hopefully either way, I hope this video will still be at least a little informative, at least a little exciting, maybe for any new subs or new people that join the stream. But yeah, we're basically going to be covering, is dividend investing worth it, right? Because again, it's making waves out here in finance tube, and a lot of people want to invest and build that extra paycheck, right? They want to have an extra paycheck. That's really what it comes down to. I mean, who wants to work for money, right? Like, really, everybody wants to build passive income of some sort so that they can, retire early or maybe supplement their income, maybe have an additional stream of income. There's that quote out there, I'm sure most of you've probably heard, where it goes, most billionaires have 7 streams of income or something to that effect, right? 5 streams, 7 streams, 10 streams. It seems to change with every new every new person that covers that quote. But yeah, what this video is to help kind of dispel some of maybe the rumors or maybe clarify a couple things, because there's 100 ways to skin a cat, right? 100 ways to skin a cat, just like there's 100 ways to do dividend investing. You can invest in blue chip stocks. You can invest in high yielding single companies like business development companies, real estate investment trusts, or even just regular dividend paying stocks. There's also mortgage REITs out there. Then there's the dividend paying ETFs. A lot of them have been making waves recently. So, we're talking, like yieldmax, high dividend yield ETFs, or curve, or any, global X cover call ETFs, like QYLD. There's 100 of them, 100 different types of high dividend paying ETFs out there. There's even the super dividend ETFs out there that, they may not pay as much, but they're still relatively high compared to individual stocks. So, we're going to talk again about dividend investing for this entire stream, whether it's actually worth it or not. What's up, G bro? Hey, welcome back. Yeah, man, absolutely. Get some food, brother. Hope you have a good, I think it's dinner time where you guys are at. So, but yeah, anyways, guys, we're going to get started, and I'm just going to be talking, and then I'll check the chat here in a little bit. I might have to cut the stream short just as a heads up, because I do have some things that are happening over here that I have to be ready for. So in case I cut the stream short, just know that caveat is out there. All right, so let's talk about dividend investing, and I'm going to just share a lot of my thoughts and kind of what I, have encountered during my time, right? One of my more popular videos was talking about dividend investing and kind of the evolution of the dividend investor. Usually most people will go in as a, index investor, and then they'll start to learn about dividend investing either through YouTube or through their friends or some other investing circle, right? And this all sounds great. It sounds amazing. Who wouldn't want an extra paycheck, right? Who wouldn't want to build up an extra stream of income, right? You see these other YouTubers out here who have, $1 million portfolios, $100,000 portfolios, and they're producing and pumping out, dividends every other week, every other month, sometimes to the tune of $1,000 or as high as $5,000. I've seen, not YouTubers, but I've seen, Reddit posts and just other posts of people getting almost $12,000 a month checks strictly from dividend investing. Now, dividend investing is a very, very broad topic. Okay. It's very broad. There's 100 different strategies. So we're going to just, again, try to kind of go through this topic piece by piece. So anyways, just to summarize, kind of that video that I just mentioned, investors will typically start off as like an index investor. They invest into the S&P 500. they usually start to get up to some type of, monetary value. Usually it's maybe 100,000, maybe it's 50,000, maybe it's 25,000, right? They were able to build a small pot of wealth, usually in an index fund. And then they start seeing, or they start thinking, it would be nice to have more dividend income, right? Because as we get on with life, we start to realize what are the most important things, right? It's time with family, it's health, it's fitness, it's relationships, times with friends. All these things start to play a factor. And then we start thinking in the back of our mind, well, maybe we should invest in dividend paying stocks so we can leave our job a lot easier or a lot quicker, right? If we snowball and compound this dividend snowball fast enough, then we can eventually leave our jobs and, spend time doing the things that we love rather than being stuck at work. That is all well and fine. Those are really good ambitions. Those are really good goals. Those are really good values, but I think, again, what usually surprises a lot of people who get into dividend investing is how much money it actually takes, right? Now, there's two extremes to this, two very large extremes to this. There's the one end, which you can actually almost not retire, but, I guess if you're making $50,000 a year at your job, with $500,000, you could almost make $50,000 a year in dividend income, right? But you'd be investing in some very, high yielding ETFs of some sort, right? Or dividend paying stocks, whatever it is, or there's closed end funds, all these other things. You could almost do that, right? Then there's the other extreme where people, they build up these, massive portfolios again that are producing, $50,000 a year, but they might have a portfolio of $1.5 million or maybe $1 million, right, at a 5% yield. So there's so many different ways to skin this cat, but let's take a look at both extremes, right? Because as you're moving on in this journey, as you're moving on through your life, as you're moving on through, work and figuring things out, especially in this investing stuff, let's talk about the extreme of high yield investing. Okay. Cause this is something I'm actually starting to dive into a lot more now, because it's something I always shied away from. And I had some own internal biases as being, an investor, a prudent investor, that kind of steered me away from high yield investing. But now, as I'm getting more exposure to it, it's starting to make a lot more sense. It is starting to make a lot more sense. So high yield investing, usually there's these things called cover call ETFs, right? That's everyone may know what these are. Basically, it's cover call strategy, or doing call options, is more of a trading strategy. It's what traders use to basically generate additional income off their stock portfolio. But if you don't want to learn that, if you're like me, you got busy, you got stuff to do, you're not trying to sit in front of a computer, you're not trying to learn all this extra stuff, you could just outsource it to a pro, right? Outsource it to a fund of some sort, like an ETF, where the ETF will generate those call options for you. So there's a couple different popular ones out there. There's, QYLD, there's the stuff from yieldmax, there's yieldmax, there's the more popular one that's been making a lot of waves is MSTY. They got a few other ones coming out. They have a new one that's coming out that does 0 day to expiration, 0 DTE strategy. But yeah, there's all these new ETFs, right? And I don't have the time to learn all these different strategies. I don't have the time to be on my phone on Robinhood, executing trades or doing this or that. Instead, I would rather just pay someone to do it and go with an ETF, which is, the expense ratio. So I could technically go into these ETFs, right? Let's say I had only $500,000, right? Only $500,000, right? I could generate my entire year's salary. If I was at a $50,000 a year salary, I could generate my entire salary off of these cover call ETFs, right? With only $500,000. Most people think you need, $1 million, $2 million, $3 million to retire. Well, yes and no. It depends what your goals or aspirations are and what how you plan to live and all these other questions. But you could almost have a very comfortable life with $50,000 a year. If you made $50,000 a year and you didn't work, so that means you probably wouldn't really actually need a car. If you're traveling to work, so let's say you live in the city, or maybe, you decide, hey, I'm tired of the United States, I want to go live abroad, right? In a low cost of living area, maybe a low cost of living country, right? $50,000 could go a very, very long way. I know Dominican Republic, Puerto Rico, well, maybe not Puerto Rico, but definitely Dominican Republic, and even Central America, and even South America, and even Mexico. Like there's all these countries in between where $50,000 a year in income would make you basically a billionaire playboy down there. Like you would have enough money to live very, very comfortably, depending on if it's you or you and family, right? So a lot of people think that you need to have an insane amount of money in order to do these things. But with these new cover call ETFs coming out to the market, and high yield investing becoming very prevalent, it's becoming more and more attractive. It's becoming fun. Like the idea of being able to quit your job much sooner and go out and enjoy your life. Maybe you don't want to quit your job, entirely, and you just want to be able to relax a little bit, right? Be able to take a year off. Well, you can do that with these cover call ETFs, and it would only take you maybe $200,000 to $500,000, right? I know that sounds like a lot, but again, hear me out. If you've been working for 10, 15, 20 years and you have that in an index, and your index isn't really growing as fast as you would like, or it's not producing enough dividend income, again, I'm not saying cash it all out and go straight into a cover call ETF. But I'm just saying, it takes less money than we think. It does take less money than we think to generate $50,000 a year in passive income through these, new instruments, these new cover call ETFs. Because I remember way back when I was, learning all this stuff and actually coming up and investing my money, I stayed away from cover call ETFs. I did invest in them. I invested in 3 of them, ended up pulling the money out. And instead, I wanted to artificially create my own yield, which brings me to the other extreme of the spectrum. So we have the high yield dividend ETFs over here, and then we have kind of the slower blue chip dividend paying companies or ETFs over here. So one of them, like one of the sectors, I guess, that I invest into heavily is real estate investment trusts. And that's because they pay out higher than normal dividends. But not only that, I mean, I know, and love real estate as an asset class, but there's also business development companies, there's energy companies, there's telecommunication companies, there's dividend aristocrats, there's dividend blue chip stocks, there's dividend paying ETFs like SCHD, which is known as kind of the king of dividend investing. So there's all these different instruments on this other side, but they would potentially see growth plus capital appreciation or passive income, right? So you're going to see that on this side of the spectrum. That is attractive. That could be attractive for some, but that is where you're going to need the $1 million plus in order to generate anything worth it. Right? It's going to take a lot of money. Yes, you can compound your money. You can do the DRIP, dividend reinvestment plan, where you reinvest your money back into the portfolio, which buys more shares, and those more shares pay out more income. The more income you get, you buy more shares, and it's just a snowballing effect, right? It's money buying money. But that still takes a long time. 1, it takes a long time, and 2, it takes a lot of money. Even if you had $1 million in SCHD, it would only produce about $40,000 a year, right? And, on top of compounding, on top of growth, on top of reinvesting the dividend, you could, potentially have more. But again, it would take $1 million, whereas with these cover call ETFs, you could do it much faster in a shorter amount of time, depending on how good your savings is, your savings rate, and all that other stuff. We have to also be realistic about this stuff too. So those are really the two spectrums, at least in my mind. You have to really, and I mean on the extreme ends too. I'm not talking about the middle, right? The middle, you can have your cake and eat it too. You can have, high paying, yield ETFs, yieldmax ETFs, or whatever, your high paying cover call ETFs. You can have those for sure. You can have those. And you can also have growth, and you can also have blue chip stocks or regular stocks, or maybe stocks that you want to invest in. You can have either or, right? You can have both. You can have all. There is no, there's nothing in the rule book saying that you can't do any of this stuff, right? But when you start thinking more as a prudent investor, you have to start thinking what actually makes more sense to you. Does it make sense to have all this stuff, and then you're going to have to deal with the tax burden afterwards, right? Because there's going to be taxes on all this stuff. Does it make financial sense for you and your tax situation? Are you going to be living off this stuff? And then, if if let's say you quit your job, you're gonna have no insurance, you got to pay for it, like all these other questions come into mind. But what I'm saying is, at least for the purpose of this video, there's two extremes, right? There's the high yield dividend paying people that subscribe to that. Then there's the prudent, I won't touch cover call ETFs because of NAV erosion, yada yada yada, and they're on this side, right? And they invest in a little more prudently. And me, I'm starting to think I really want to migrate away from, kind of this side from the prudent, I won't say prudent. That's not fair. Cause both sides, they have good arguments. They're well invested and they're pretty intelligent, right? The arguments are good, but I would say I am thinking about migrating money away from, the slow growth type of stuff, the slower income type of stuff, and migrating it into higher yielding instruments. So there's 100 different ways to go about this. But yeah, let's move on. Let me check the chat real quick. Say hello to everybody. So G-Bro already said hi to you, sir. Hope all is well on your end. Manish Chopper, yeah, 0 DTE, yep, daily calls. Yeah, that stuff, and yieldmax just came out with a new one, so that one's interesting. Yeah, taxes. Hey, BR Supreme Constitution. I think this is the first time I've actually seen you in a chat, man. You've been a long time OG, just watching the videos, man. Appreciate you very much. But yeah, all right. So moving on. Yeah, taxes absolutely is going to kill a lot of this stuff, right? When we're talking about dividend investing, a lot of people don't think of the other end of this, and that is the tax situation, right? The tax situation that these ETFs, that these companies, that these other instruments create. So real quick, in case you didn't know, there's 3 classifications of dividends. All right, and I'm getting way too into the weeds, but this is almost a masterclass on just dividend investing. But yeah, when we're talking about dividends, there's 3 different classifications. You're gonna have your ordinary income. Right? This ordinary income is going to be taxed at your ordinary rate, right? So if you're in the, 27% tax bracket or whatever it is, that's what is also going to be applied to your ordinary income, all right, or the dividend. So just know that. And again, I'm not a tax person. Don't take this as tax advice or anything like that. I'm just telling you what I know. Also, just a point, when you have your dividend income, right, that can also raise your tax bracket as well. So just know that. So if you make, let's say, $10,000 or an extra $50,000 in taxes, and you're making $50,000 a year, well, on paper, in the eyes of the IRS, you're making $100,000, right? Because it's all income, right? But again, it depends on the dividend classification that will make or break that piece. All right. So, but yes, we have ordinary income. Then you have qualified dividend income, which is, you get that tax break. I forget what the tax brackets are for qualified dividend income, but they're very favorable. So you're going to get a decent haircut on that tax burden. And then you have a return of capital. Now, return of capital is very prevalent in cover call ETFs, and it's very prevalent in real estate investment trusts. All right. And the way you think of return of capital is that the fund or the REIT or the company is literally giving you your money back. It is a return of capital, a return of your money, right? So there is no tax on this stuff. I have seen videos and heard of heard of cover call ETFs providing, 80% return of capital, right? Which this is the reason for the NAV erosion, but I will get into that probably in a much later video because I'm learning about that stuff now. But anyways, for that dividend, you're going to get that return of capital. Some of these cover call ETFs are pumping out that return of capital. They're giving you that return of capital, right? And then a little bit of that money from the strategy that they're implementing goes to the NAV, goes to the net asset value, which causes that ETF to rise. So it is interesting, but again, as an investor, if you're thinking about investing in dividends, if you're thinking about investing in dividend paying companies or ETFs or things like this, you have to keep that in the back of your mind. You have to understand the tax consequences that come with this. So dividend investing overall, like, is it really worth it? Is it really worth it? Yes, in my opinion, if you have the time and the patience, because this is not going to be easy. Whether you're going with a cover call strategy or you're going with, the lower paying ETFs or, like SCHD, or maybe you're going with REITs or maybe business development companies, or maybe a business development ETF, I don't know, or blue chip stocks or whatever, right? It's going to take time. It's going to take a lot of time. Okay. Unless you're already wealthy, you already have a sizable amount of money and you could just drop it into something, then totally different. Right. But it's going to take time. You're going to have to work and, not to get too much into the personal finance thing, but if you want to expedite this journey of building passive income, of building an additional stream of income through dividend investing, through the stock market, then you're going to have to make more money. Right? This gets into a whole other slew of things, right? You're going to have to take on more responsibilities. You're going to have to get certifications, get more education. You're going to have to promote at work or find a new job that's going to pay you more. You're going to have to be valuable, provide a service, be marketable. And you're going to have to work on all these skills. All these things come into play to make more money, right? And then you use whatever that money is, assuming that you're keeping your expenses low, you're not yellowing your money at the bar, yellowing your money at the club. You're going to use that money and go invest into actual assets that produce money. This is why I prefer to call myself a cash flow investor, because I am always investing for cash flow. Some people, and this can go on and on, but some people, well, let me take that back. Their traditional advice will have you believe that as a young person, you should invest for growth and then transition into dividend paying in the later years. And while that is absolutely 100% good advice, not everyone, wants to do that. Not everyone wants to work until they're 65 and then transition their portfolio into bonds and dividend paying companies and things like that. There is a new generation of investor out here that wants to make money now. And leave their jobs, create a second paycheck so they don't have to rely at work, and they can go travel, they can go have fun, they can be with their families, they can, hang out with their friends. There is that generation, right? That new investor, and they're not waiting. They're not just putting their money into an index and calling it a day and waiting. There's investors out here on YouTube right now that are just investing purely in dividend paying companies, dividend paying ETFs, or even high yield cover call ETFs, right? There's investors like that right now. And I think, only time will tell what made the most sense, right? Only time will tell what makes the most sense. I mean, if you could, let me ask you guys right now, if you could retire right now at the age you're at right now, making your full salary in dividend paying stocks, but you're going to see no growth, you're going to see absolutely zero growth in your stock portfolio. So would you take that deal? Yes or no? I'm just curious what you guys would do, because this is a serious question. And this is something that a lot of people look at. They would rather make the money now, right? They would rather have the income now and they can forego the growth, or maybe they do a 50-50. I don't know. Maybe they'll have, an index fund, something that can grow on the side, passively. They don't have to touch it. Meanwhile, they have the other, income coming in from dividend paying, stocks, ETFs, and cover call ETFs, things like that, So, hey man, I'm on fire today. All right. I got this coffee. Honestly, I wasn't sure how this stream was going to go. Just going to check the chats real quick. Let's see. BR Supreme says, I hope Trump gets rid of the IRS and pushes states to repeal the 16th Amendment, ending direct federal income taxes. It let people keep more of their earnings, dividends, without the government taking a cut. I 100% absolutely unequivocally agree. I hope something comes positively for us as the taxpayer. where we're not getting screwed every which way. You know, this is why so many of us look for loopholes, right? It's because of this. So I'm so glad that, you know, hopefully under this current administration, and I don't want to get into politics, guys. I don't do politics on this channel, but I hope under this current administration, some favorable tax incentives come out. Like, I do like the whole, you know, not taxing overtime. Not that I don't have a job right now, so it doesn't apply to me. But, you know, in the future, if I do have a job, I would absolutely love that, because I would just use that extra OT money and buy more income producing assets, right? More income producing stocks, dividend paying ETFs, things like that. So absolutely 100%. Hey, Mark, good morning, man. Good morning. Thanks for joining. Yeah, I would fire my boss 100%. Yeah, absolutely. If I had, you know, if I was making my salary at the time and I wouldn't see another dime of growth, right? Another dime, but I could make my entire salary for the year, I would 100% fire my boss. I'd be peace out, right? I'd fire the company, as a matter of fact. And quick little side note, quick story. I actually, when I left my job, I ended up buying their stock. I bought one share because I want to make sure that they're providing me shareholder value. All right. It's a little pettiness, but I thought it was kind of cute. Anyways, let's see what else we got. Galveston County Mike. Hey, good morning, man. Good morning. Good morning from Texas. Well, good morning from Thailand. I think it's almost evening from your on your end. BR Supreme Constitution says same income with only dividends but no growth. I suppose so, as long as the cost basis doesn't go down. Hey, you know, like I said, if you could make your entire salary in dividend income, you know, but you would see no growth from your portfolio, would you take it? Right? I know I would 100%. I wouldn't even second guess myself. I'd be like, peace out. Anyways, all right, guys, let's continue on with this, because I want to keep this momentum, because I'm on a coffee fueled rant right now. So let's go back to dividend investing and if it's really worth it, right? So we covered the both extremes. We covered how much money it could potentially take you depending on which strategy you're going to be employing in your portfolio, or maybe it's a mixture of strategies, right? So we already covered kind of the tax burdens and the situations that could create for you, which, you know, would be a big problem, right? You don't want to be paying a lot of taxes. So this is where you have to kind of think, you know, in the future, if you like what you do, you love your work, you love everything else, you know, all things equal, there's no issues at work, you're a rising star, you're on a progressive path, whatever that is, you could always consider putting these in tax advantage accounts, right? So you would get the tax advantages, you could build it and snowball and create huge amounts of wealth, compound your income, compound your, you know, dividend paying companies. You can compound all of that by keeping them in a tax advantage account of some sort. You know, a lot of people would rely on like a Roth IRA or maybe a regular traditional IRA. 401k plans, as far as I know, unless they're those special, you know, solo 401k plans, or maybe it's a SDIRA or SD 401k, self-directed 401k. Typically, most 401ks that I've come across, they all have only a certain amount of funds that you're allowed to invest in. They don't allow you to invest in, you know, cover call ETFs, or bond ETFs, or dividend paying ETFs, or even single stocks, or even crypto. You know, will that change in the future? I don't know. But it all depends on the company you're working for and the 401k plan. But moving past that, you know, the whole tax advantage piece would be, you know, absolute killer, like absolutely killer if you wanted to invest for the long term and build up a lot of passive income in a tax advantage account. Because then at 59 and a half plus, when you decide to retire, you decide, hey, I've had enough, you know, you can start taking that money, right? And again, not tax advice. I'm not a certified financial planner of any sorts or a certified financial advisor. You should talk to those people for sure to get a full picture of your own financial, you know, plan, your own financial picture. But for me personally, I'm at this point in my life, and maybe it's, I don't know, maybe I'm having a midlife crisis, but I'm at this point in my life where, you know, I have a sizable 401k, and I have toyed with the idea of taking that money out and using it to buy, you know, sprinkle it across crypto, sprinkle it across, you know, cover call ETFs, and sprinkle it across, you know, probably other high growth ETFs, maybe something like a VGT or a QQQ, or maybe I'll just dump it all back into an index. I have no idea, but having money in a 401k my idea has always been that I wanted it to be an insurance policy in case something bad happens, in case I blow up my portfolio so bad that I can't recover. At least I'll have a 401k that has, over the next 20, 30 years has grown substantially, right? Anyways, all that aside, what's up, Danos? Hey, welcome back. Yeah, appreciate that, Galveston County. Yeah, hit that like button, guys. I hope you guys are enjoying this rant. Like this, I'm not even sure what this is. I guess I'm just talking about dividend investing, right? Okay, so dividend investing. Let's get back to it. All right. As a dividend investor, your primary focus is to build passive income, right? But you can't just be investing in anything that produces the dividend. There's dividend companies out there, dividend ETFs out there that can royally screw you and set you back quite a bit. Okay, dividend companies, they have, in the past, especially during C19, they suspended their dividends, they reduced their dividends, or they flat out just cut all their dividends, say, hey, we're not paying any more dividends anymore, right? That would be a absolute burden on the investor who's actually trying to build passive income. This is why I advocate that people should always look at ETFs before they start looking at individual companies. Now, individual companies, investing in individual, dividend paying companies like, REITs, for example, or BDCs, while that is, I guess there's a sexiness factor to it. If you're not understanding all the companies you're investing into, if you're not doing all the proper research, monitoring, controlling everything, all that stuff that goes into portfolio management, if you're not doing all of that and you want to be more of a passive investor, then go with an ETF. Because if you're not doing all those things, if you're not keeping up to date with all your holdings, if you're not understanding what's going on with each of the companies, you could lose a substantial amount of money, right? You could lose a substantial amount of money. And imagine losing $25, $50, $100,000 in a single company, right? That's not producing any more dividends or any more, passive income for you. And now, since investors are pulling their money out because they'd be pretty pissed, that's going to cause inevitably the stock price to go down. And now you're losing money. So again, these are things you have to keep in the back of your mind. And this is why I advocate go with an ETF. It's completely passive. You can hold it for long periods of time. And, these are typically baskets of, 25, 50, 100, 150 different companies. So you're not having to do any research on these things. The ETF manager is the one that's doing all the research and maintaining that whole fund. Again, when you buy an ETF, you're buying a basket of individual companies, like a basket of eggs, right? So you don't have to worry about it. When you put $1 into an ETF, it's getting split, 50, 100, 150 different ways. So you don't have to worry about that. So that is why I would always advocate that people start with ETFs, and if in the future you want to go with the single company route, then you can do that, which is why I think the whole cover call ETF stuff is becoming way more, prevalent now, because, back as far as I know, when I first started looking at these way back in 2022 and 2023, there weren't any single cover call ETFs for individual companies. It was usually cover call ETFs against, the indexes, against the SP 500, against QQQ or the NASDAQ 100, right? Or against even the Dow Jones. But now, or the Russell 2000, but now there's cover call ETFs for single individual companies. But you need to really understand what and how this ETF works, right? And how it produces this dividend. Because these dividends, while they can be attractive, and again, I'm going to go back to yieldmax because I think they're the more popular one now, but they're producing distribution rates of 100%, 100%. Okay. That's 100. You can make back your entire investment in under a year, right? Probably less than that. So it's wild to have and to know that these things exist, right? But there is a degree of risk that comes with these, because you have to understand what the underlying security is, or what the company is that these cover call ETFs are writing cover calls against. So you have to understand that. So it's a little more in-depth research. And then do you or can you hold these cover call ETFs for 5, 10, 15, or 20 years? I don't know. I have no idea. But I do know that these things, they're creating a whole new market for investors. Like, they really are. So I think right now is a great time to get into cover call ETFs. If you haven't, and I'm not saying just go out and start buying them, but I'm saying that, having good research, doing the research, understanding how they work will actually play in your favor. Because again, when I first started looking at these, I had a huge bias. I was totally against cover call ETFs after being in a few different ones for, I think it was like 6 months or so. And the total return was the total return with dividends reinvested was actually not bad. It was pretty good. But, when you compare it with an index fund, I mean, it's going to get wiped out, it will get wiped out, period. But, again, with these newer ones coming out and these higher distribution rates being reached, I could see, a place in the market, a place in investors' portfolios for these things. So, let's see. BR Constitution says 100% is insane. Yeah, and these new ETFs that are coming out, they all have this really ridiculous distribution rate. I've seen some for like Bitcoin ETFs that are doing cover calls against Bitcoin ETFs, and these things are producing, either between 65 and 85% distribution rates. Like, that is really crazy. And it's doing it against Bitcoin, a cryptocurrency, right? So if you're, wanting to get that exposure to cryptocurrency, that could be one way while, getting some type of income. So, to bring it all home, is dividend investing really worth it? And again, it's going to come down to the individual investor. What makes sense for the individual investor? Can they handle the tax burdens that are going to come with this, or do they not care? Because I guarantee there is a sect of investors out there that do not care about taxes. They will pay the taxes happily on $120,000 coming in or $50,000 coming in from their dividend portfolio, right? They would happily pay that, and the smarter, probably more prudent, more well-informed investor is going to look for ways to reduce the tax burden, by, probably ways of using LLCs, not LLCs, but using, businesses or something else to help kind of bring down that tax burden, right? And again, we have a new incoming administration, so we'll see how, how all the tax brackets change. I believe they already changed. I haven't done a deep dive into what's good or what's bad, but I know that the general consensus is that under the current administration, the tax cuts look like they're going to be really favorable for the everyday American, for, you and I. So this is all good stuff. All right, looking at the chat, let's see. BR Supreme Constitution says, I don't really get cover calls, so I'll keep it simple. Tempting, though. Absolutely. I would look at them. Again, they are very tempting, mouth-watering even. But when you start to look at charts and you kind of start to look at, comparisons, again, sometimes these cover call ETFs can be a danger. So you gotta be careful, especially if you're trying to grow your wealth, if you're trying to grow your net worth, because your net worth really is your scorecard. Right? I don't care who says what or who disagrees with this. Your net worth is your financial scorecard. And if your net worth is declining because you're all into cover call ETFs and you're just spending the dividend, the distribution income, then your scorecard is going down, right? There's nothing you can tell me otherwise. If you have a difference in opinion, I'd love to hear it. But yeah, very tempting. But again, every investor is going to be a little different. Some people don't care. Some are like, whatever, I'll deal with it. Maybe people are using that extra income it's generating to buy additional assets, right? I've seen that strategy where people use cover call ETFs and end up using the distributions to invest into the underlying security. So if we have like a QYLD, this strategy is called pairing. So you'd basically have QYLD that does cover calls against the NASDAQ 100, but any of the distribution you could use to buy into QQQ. Or you can reinvest it back into QYLD while continuously investing in QQQ, right? So you're getting growth and you're getting income, right? This is known as pairing. Don't ask me the super finer details or what, how these stack up against, maybe an S&P 500, because I haven't really dug into that stuff in a long time. But yeah, the strategy is called pairing. Let's see. Nanos says, if you had $600,000 right now, would you break it all into dividend generating ETFs and stocks? Well, I would, yeah, 100%. Yeah, at this moment, absolutely. If I, let's see, because I have real estate holdings. So I have a mixture of real estate. I have real estate investment trusts. I have an index, and I have, a little bit of crypto and a little bit of cover call ETFs. I think I shared with you guys that I put like 1,500 into Misty. I want to increase that, right? So if I had to take it all out, if I had to cash everything out right now and then dump it into something, I would probably do a mix of cover call ETFs and growth, something like a VGT and maybe a cover call ETF of some sort. I do like the new one, or I do like not the new one that yieldmax came out with, but probably just anyone. I think Rex has a few of them, but it's basically the XDTE is the ticker, or it's QDTE. I think I'd go with QDTE if I had to pick between the two. But you're getting income and you're getting growth, right? And they're paired. So if I had to cash out everything, I would probably go that route. I'm not saying 100% with conviction I would, but it would be something I would probably strongly consider for sure. While I do love REITs and I do love real estate, these last couple of years have been hard. I'm not going to lie. They really do test you as an investor and really test your patience. But again, at this time in my life, income is kind of everything. Cash flow is everything. So I have to keep that in the back of my mind. How much do you think you will need to live off dividends? Well, for me, it really depends. If you're a single, bachelor addicted to retail, you're probably going to need a little more, right? $50,000. What would you do if you had $50,000 a year in passive income with no job, right? How would you live? Would that cover your expenses? Is that going to cover your rent, your food, your utilities, your cell phone bill, your internet? I don't know. Are you a gamer? Do you play a lot of games? Like, you have to take into account all these different expenses, and if your dividend income will be able to pay for all of that. However, the cheat code or not the tax hack, but the hack to this is moving to a different area, to a lower cost of living area, right? You can move to Southeast Asia. You can move to Central America. You can move to South America. You can move to the Caribbean. You can move to parts of Europe, parts of Africa, right? You can move to these different areas where 50,000 USD will go so far. Like, you could live like a straight up, king in some of these countries with $50,000 a year. So again, it really depends on your situation. For me personally, here in Thailand, $36,000 a year would not even $24,000 a year. If I can make $24,000 a year in passive income, I would never have to go back to a W-2 job, right? $36,000 would be icing on the cake, and $50,000, man, I'm living in a penthouse at that point. I'm living in a penthouse in the city, or maybe I'll keep, a Airbnb right by the beach, in case I want to go down there for the weekends, and then I'm living out here in Bangkok, right? I mean, wow, $50,000 a year, you're traveling, you're having a lot of fun out here. Sita, hey, welcome. Did you just jumped in? How's the stream going? So it's going pretty well, man. I'm just venting about, dividend investing, really worth it. I had to check my own topic. I know I did a video like this a couple of times, but there's always a new nugget of wisdom in these talks and these conversations. So today was kind of a slow news day. So again, I'm just kind of talking, but I do have to caveat that, I do have something happening here in probably the next couple of minutes. So I may have to hop off on the stream. But anyways, hope I got through the chats, and Danos asks, do you do options trading? So me personally, I don't do options trading. I never have. I never done any sort of trading. I will say, I take that back. I did try to do swing trading, where you buy a stock or something like that, and you hold it for a couple of months to see if your thesis plays out, and then you sell for a profit. So I tried to do that myself. Did not work, right? Did not work. I tried to do that with crypto. Did not work. I think I had the losses tallied in honestly under like high 15s, like $15,000 in losses. So those scars run very, very deep. And I don't intend to do any type of trading ever again, because it's not something I want to do, right? It's just not something I was doing. I hopped in those trades only because I had a lot of FOMO, and only because I was listening to friends, right? And every friend was like, oh, dude, do this, do that, right? I'm making all this money. Fun fact, I had a friend who invested in a crypto coin that was called, not XRP, but anyways, I can't remember the coin name, and it's going to kill me, but I don't want to kill the stream. But he invested in this crypto coin. He got it to $1 million. It was called VeChain. He got it to $1 million, and he should have sold. And there was a part of me that wanted to tell him, dude, you should sell. But he was under the impression, no, I'm never going to sell. I'm going to get this thing to 2 million, then 3 million, and 4 million. And then that crypto crashed, and I don't think it's ever recovered. I haven't checked ever since. But that was a couple of years ago. during 2020 into 2021. So that's when interest rates were low. That's when crypto was going crazy. That's when the GameStop mania was happening. All that stuff was happening in 2020 and 2021. That was a very crazy time. But let's get back onto the dividend investing stuff. So again, dividend investing. All right. So we covered a lot in this stream. We covered, kind of the extremes, the different ETFs, the different strategies. We covered taxes. We covered, you as an individual investor, if it makes sense for you, to kind of close all this up, as a dividend investor, what makes sense for you, right? This is where, or how, not only does it, like, how can you come to the conclusion if dividend investing makes sense for you, right? There's different camps in this. There's a camp that says, hey, invest in growth and then, and then migrate to dividend paying stuff later in life as you're getting closer to retirement. And then there's, the sect of investors who are like, no, I want to enjoy life now. I want to create a second check. I want to create a second stream of income. I don't want to wait until I'm 65 to enjoy life. I want to enjoy life now, right? They can work the 5 years, hardcore, balls to the walls, I guess, foot on the gas, all that, just going 100%, making as much money, saving as much money, no expenses, keeping expenses very low, putting a lot of money to, these cover call ETFs or these dividend paying companies or whatever, right? And then they could build and snowball that. Then there's a sect of investor that's like, you know what, I can do both, right? I can do both. I make a lot of money. I can invest in growth. I can also invest in dividend paying or cover call ETFs, right? So they're starting to do that too. I won't say starting, it's more like they have already been, because there's so many groups out there especially on Facebook, and some of them absolutely kill me. Like, it's funny to see these things in action. You'll have someone, who's, or a group that's completely diehard dividend investing, right? You can even put this on like a Reddit, and the moment you go in there with a yieldmax or a cover call ETF or something, you get roasted, right? The moment you go against conventional wisdom or conventional advice, buy blue chip stocks, buy growth and dividend income and growing dividend income and, strong CAGRs and blah, 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 blah. When you go into these groups and you post, hey, I want to invest in a cover call ETF, they go bananas. They go absolute ape shit. And they start roasting you and saying you're making a stupid mistake. You should void it. They give you 100 reasons why, but they don't even know who the investor is or who's asking that question. That person could probably already have $1 million portfolio for all they know. And they're just curious what others think, right? And then you have the other side of the house. There is a yieldmax group out there, and they go in there and people are talking about cover call ETFs are the only way to go to build other streams of income. So again, it's always going to come down to the individual investor and whether it makes sense for them or not. As a dividend investor now myself, I am thinking of transitioning a lot of my income, a lot of whatever money I do have, or cashing out or reallocating money to cover call ETFs or to higher paying dividend companies or ETFs. Like, I am actually thinking of that. And as soon as I get some additional cash or capital, either from real estate cash outs or the sale of real assets or whatever, as soon as I get that money, all that money is going straight into the stock portfolio. I could go on and on about the pros and cons of, owning rental properties and real estate and investing in the stock market or investing in REITs or investing in, cash flowing assets like a cover call ETF. I can go on and on about that, but we'll skip that for this stream and I'll probably save it for the next one. But guys, we're almost at the top of the hour here, so I'm just going to check out the comments. I'll chill out for the next 10 minutes, and then I got to get off. So let's take a look here. So G-Bro says, many nuggets, man. I appreciate that. I hope this stream is helpful for you. Let's see what else we got. Danos, selling options is like dividends. Absolutely. So a lot of people will do cover call options as a way to generate additional income. But the problem is you need a lot of money to do it, right? Unless you own 100 shares of QQQ or S&P 500 or, maybe a stock of some sort, unless you owe 100 of those, that's the only time you're going to be able to do cover calls. So it could take a lot of money too in order to do cover call strategies. But then you also have to think, yes, you're going to collect money on the premiums, but if someone does buy your shares, when you do that call option, if someone does buy your shares, you're going to lose those shares, right? So you also have to keep that in your mind, in the back of your mind, right? Because you do give up some money, you do give up some gains, right? So if you had a stock A and you're going to sell it at, or it's worth $5 and you're going to sell it at 10, but it grows to 15, someone who bought that contract is going to get those stocks for 15. You lose out on that $5, right? That $5 gain, right? So you have to think of it that way too. Let's see. BR Supreme says, wowza, does he regret not listening to you? No. He's still working. Yeah. He's a good personal friend of mine. Really love the guy to death. We worked together in Iraq. So, he's still investing in crypto. He's still doing crypto stuff. And, funny enough, his brother is a crypto insider. So I'm sure he's doing well off. I'm sure he's doing very well, but yeah, it was, we joke about it from time to time. I'll just send him a quick message. Oh, if only you sold all of your VeChain. So we'll see how it goes for him later on. Yeah, $1 million. No, it wasn't nothing to him. It's just that he wanted 2 million, right? It's that greed. And that's the thing that I see a lot with investors, is that they don't have an exit plan. This is something I had to learn myself, is you need to have and develop an exit plan for a lot of your stuff, especially for crypto, because you could be a buy and hold investor for life, but don't box yourself in and say, just because you bought something and you're a buy and hold investor, that you're going to continue holding it as it dips to zero, right? Like, you have to be intelligent about this stuff. You have to make smart decisions. But yeah, like, greed is one of the biggest things that plays against investors, right? I've seen more investors lose money, myself included, lose money off of greed alone, right? Off of greed, off of FOMO, off of emotional drives. If we were all robots and we didn't have those emotional triggers, we would stay invested, right? We would stay invested. We'd have solid exit plans and we'd always be profiting. But because we're humans, and we jump in at times where we probably shouldn't jump in, because of all the news, because of all the glitz and glamour and the gamification of investing, sometimes we lose a lot of money. But, that's a whole other topic, gamification of investing. Robinhood is notorious for this, making it look like a game, like, oh, it's just a game now, like investing your whole wealth, everything, all your money, your entire financial success is just a game at this point. Which, in reality, it sort of is. Dano says, I think if you are young, dividend investing can come later. It's about growth, build the wealth, and then move most into dividends. It's hard to live off dividends if you have a small account. That is 100% true, 100% true. But, again, those are the traditional, conventional wisdom, right? The sacred cow advice, right? Like, invest for growth when you're young and then move into dividend paying stocks, right? That is what most people advocate for. But I think there's a sect of investor now, and you can see it all over YouTube, where they're just investing in cover call ETFs. And these are pretty young people. Like, they're probably no older than 30 and 35, right? And probably as young, a little younger as, 25. But their jobs, I think, is what kind of amplifies their portfolio size, right? If you're making $50,000 a year in, let's say, New York City, which god awful place to make $50,000 because your cost of living is crazy, you're going to have expenses like bills, utilities, rent, girlfriend, boyfriend. You're going to have cars. You're going to have all this other crap you got to buy and pay for, right? But if you're making $100K in, let's say, I don't know, what's a low cost of living state or / city, whatever that is. If you're making $100,000, but you're only spending 25 just to live and cover your needs, you can quickly build a really good dividend paying portfolio fairly quickly with a lot of discipline and a lot of drive and things like that, because dividend investing requires a lot of discipline. It requires a lot of discipline. It requires, especially on the expense side, especially on the personal finance side, right? Because if you're just, and you're absolutely right, if you're just putting, $5 here, $10 here, $5 here into like 15 different companies or 3 or 4 different ETFs, it's really hard to move the needle. So 100% I agree with you. But there are caveats. There are variables to all of this. We can't blanket it in saying that all investors who are young should just invest for growth and then move to dividend paying, because maybe those young investors, want to travel the world a lot sooner than wait until they're 65, right? That's me. I definitely did not want to wait until I was 65 to be able to enjoy life, or be able to just go to the gym, for example. So just my thoughts is all, but I appreciate the comment 100%. Ben Morrow, what's up, man? Welcome. I would make sure that those cover call ETFs at least keep up with the average inflation with their dividend growth. 100%. 100%. That is 100% true. Because you need to, inflation is that silent killer of wealth. It makes more things expensive. And I don't know, maybe I'm very biased, but I don't plan to live in the United States anytime soon. I plan to at least stay out here in Southeast Asia for as long as I can. If not, even if I had to go back to a job, even if I had to go back and start doing, work and back to a W-2, I would still look for something overseas. I don't know. When last time I was in America, like you needed $100 to order anything off Uber Eats. Like it's ridiculous. Meanwhile, over here in Thailand, like for $15, you can order your lunch and dinner, for $15. And that's on the pricey side. You could go downstairs and get, lunch and dinner for $5. And I'm not even exaggerating, right? So again, inflation is a big deal, and definitely a big deal in the United States. And definitely you want to make sure whatever you invest in, the dividend CAGR, the compound annual growth rate, is growing, right? Or dividend growth rate, right? You want to make sure that they're growing at least 3% a year, right? We get that 3% from the average inflation data, but because of the last couple of years, inflation spiked all the way up to 9%, and it's been sticky between 2.9 to 3.3%. I think inflation's been really sticky around this range. The Federal Reserve is trying to get it back to 2%, but it may be a longer fight to get it down. So I think we're probably moving into this era of normalization where, yes, in the past it was 2%, but maybe in the future going forward, because inflation is not going down despite all the monetary policies and everything and all the deregulation that's happening, maybe it's just going to stay with us, right? 3% is just a new norm as it goes, right? So who knows? I don't know. I certainly don't know, but I am keeping my eyes on the news and trying to stay at least tied into what's happening, back in the States, because maybe at some point I have to move back, and I definitely don't want to be paying $100 for Uber Eats. Let's see. Mark K. Eugene, are you a veteran? Yes, I am. You mentioned Iraq. Yes, so I was in Iraq as a DoD contractor. I was in Afghanistan when I was in the service. I'm a Coast Guard veteran, so I do, have that campaign medal under my belt. Let's see. 100% agree with the statement on greed. Yeah, I think greed is the one thing. I think aside from greed, I think greed probably more so affects crypto investors, because they always get this like Lambo mansion, yacht driving, airplane flying, like beautiful women, champagne bottle popping, like view in their head with crypto. Not that it doesn't happen, but there are probably more losers than there are winners in the crypto space. And a lot of times the crypto, new projects, things like that, they call them ICOs, initial coin offerings. More times than not, those are scams. I'd put 99% to it is probably a scam. I mean, you have so many. You have meme coins. More recently was our president had a meme coin. Things collapsed. It's not going to grow back. You had before that the Haktua coin. That completely collapsed, and that's not coming back, right? And then even before that, you have so many stories out there. You have Safe Moon. You have man, I have a whole list in my head. But yeah, I'd have to go through it. But yeah, there's a ton of these coins, whether they're meme coins, altcoins, or shit coins that just they spike up. The insiders already have the money. Stupid money goes in. They rug pull, and then everyone else loses money. And then if you're caught holding the bag, you're caught holding the bag. So. Gabe Ayala, I think you're a new person. I don't think I've ever seen you before. Hello, bro. If I can commit to $125 a week, starting from basically zero, where do I start for dividend investing? SCHD, that's what I keep hearing. Thanks. I'm new to your channel, interested in dividend investing. I'm a 45-year-old construction worker, so very labor-based work and income will decrease probably as I age to 55, probably. if I not knowing your full financial picture, so I just want to be careful out here. And again, if anyone in the community, anyone in the comment section has anything else, please let's help this person. All right. So because we can all learn together, right? We can all learn and grow together. All right. So if you had 125, and let's say you have no net worth, right? You have zero net worth. Based on your comments, you're a 45-year-old. I would honestly commit to probably something of growth, right? Something a lot, something for growth. I would probably commit to the highest growing ETF I could find, which in my opinion would probably be something like a VGT or a QQQ or even an FTech, something very tech heavy, because tech grows substantially faster than dividend paying companies or dividend paying stocks or dividend paying ETFs. So I would go with something very, very tech heavy. And just to note that this is not financial advice. This is just my thoughts. But yeah, I hope that answers that extremely well, because you're nearing probably closer to retirement, and you're gonna want a fatter nest egg at the end of retirement. Assuming this is going to be in a taxable account, let's hypothetically just make up some numbers here. If you were to get this to $1 million, right, over the next 15 years, which would put you at 60 years old, if you were able to do that, not sure how, but if you're able to do that, you can take out $40,000 a year to cover your expenses, right? And then you can start drawing on Social Security, and then maybe you have a pension of some sort. I'm not sure if you do or don't, or maybe other retirement income sources. But yeah, $40,000 a year from the index, from something or like a VGT, it's going to continue growing. You could take that 40,000 and, use that to cover some of your expenses. Just know that whenever you take anything out of a taxable account, it is going to be taxed. So you have to keep that in the back of your mind. So hope that helps you. Let's see. Mark K says, no way. ME1 right here. All right. There we go. Hey, we got another Coastie in the channel. Damn, man, we're like unicorns. I swear you never hear about us. I was at ME too. I was at ME second class. Man, that's crazy. That is crazy. Got out in October of 24. Yeah, I was down in I was part of the raid team. That's how I got into Afghanistan and Kuwait. So I'm familiar with Pat Forsois and Bahrain. So that's interesting, man. That's so cool. That's awesome. It's always good to see another Coastie in the out there in the world, I suppose. Fun fact, or funny story. When I was in Iraq, there was a guy who rushed into my office, and he was like, and I knew him. We talked a few times, and he was like, "Bro, I didn't know you were in the Coast Guard." I was like, "Yeah." He's like, "Man, I was in the Coast Guard too. I was a BM1." I was like, "No way!" And we just hit it off right there. So like, it was funny. His name, I forget his name now. I have him on Facebook, but yeah, he's a good dude. Yeah, Gabe. Again, hope that advice helps you. At least paints a picture for you. Again, not knowing your full financial picture, that would probably be something we'd have to speak about offline. I put this year's tax return in Roth IRA with a portfolio full of Meta, Nvidia, Palantir, and Costco. Not going to comment too much on the individual holdings. I do like the holdings though. I mean, you got a lot of tech in there. Palantir just had a great earning seasons, I guess, or earnings call, whatever you want to call it. Nvidia, you can't go wrong with them. I mean, I think they're going to be the AI leader over these next 4 years and definitely into the next decade, unless, AMD, comes out of nowhere with something. But I think Nvidia is pretty much going to be, the Google of the tech companies, right? Or even, I think Nvidia, that's not a good way to put it. I think Nvidia will be the Apple or Microsoft of this sector, right? Of the AI sector, for hardware anyways, for chips. So Meta, absolutely, you can't go wrong with Facebook. I mean, they've been on a tear. Although I don't fully understand I know they're coming out with the metaverse and everything. They make a lot of money off ad revenue, with Facebook ads. But I don't really know what the hype is about Facebook. I just don't get it. But again, I haven't really researched that far into Facebook or into Meta. I know at one point they tried to do what Elon Musk is doing, and that was providing free internet via a drone, like way back when. They tried that experiment and it didn't work out. So I was actually surprised to see that, and interesting. It's all interesting. But but that's it. I'm going to play it safe from here. No, not so much individual stocks. Yeah, just be careful. Like you don't be so concentrated. You could do what's known as a core satellite approach, where you'll have like, let's say 40%, 50% of, let's say you had 100,000, right? And let's say you had Meta, Nvidia, Palantir, and Costco. Maybe it'd be prudent to have like an index in there, like an S&P 500 or something, like a basket, like an ETF, maybe like a VGT, maybe like a QQQ of some sort, right? So you're getting the whole market. You're getting a broad market ETF index fund of some sort. BR Supreme Constitution says Gabe needs to invest $3,000 per month for 15 years at an 8% annual return to reach $1 million with dividends and reinvested. Yeah, I mean, that sounds about right. 100, like I said, $125. Again, it's just a start. So you're talking what? That's $500 a month. It's better than not investing anything, right? So again, I would recommend investing into something high growth, because you could get that potential 8% return per year with something like a very tech heavy ETF, in my opinion. Okay. In my opinion. All right. Dividend investing is what's intriguing to me overall. Yeah, I'm a huge dividend investor. I'm a cash flow investor, but again, my situation was very, very unique. I was working in the Middle East, making very high income. All right, because I was a DoD contractor for a very long time, so I was making a lot of money. So I could afford to wait. I could afford to do that because I was putting so much money in dividend paying stocks that I could build, additional stream of income. But again, it took a lot of money. It took a lot of time. So you have to compete with that. Like time, because you're at 45, it's not entirely on your side, right? So this is, again, just a variable you have to keep in the back of your mind. If you're trying to build a fat portfolio fast enough, again, my opinion is go with something geared towards growth. Yeah, Dano says Meta ads makes billions. Absolutely. Yeah, I've used Meta ads before, and I plan to use them again. But I do like the platform that they have. Gabe says, right, I'm 45. I wish I knew more when I was younger. I mean, we all do, man. I didn't start investing until I was like 26, and like it was 27 when I made my first like purchase. But up until then, all I knew was the same operating system we all live off of. Go to school, get good grades, get a good job, work 40 hours a week, get paid, get more money, get a raise, 3% a year, right? And then just do that over and over and over, right? I didn't know about investing. It only happened because I ended up going to Iraq and I had money, and I was like, I wonder what, I should do, because I always thought that you needed to have a business of some sort in order to make millions of dollars. I didn't know you can invest in companies. So when I learned that was like, right. And then reading Rich Dad Poor Dad, the rich don't work for money. That just, again, blew up my mind. So then I went down the rabbit hole. But yeah, I totally get it, man. I totally understand. Yeah. I wish I knew this stuff a lot sooner, a lot earlier. But starting at 45, am I too late for dividend investing? I wouldn't say you're late. I'm just saying that, it's going to take a lot more money. It's going to take a lot more time. Unless you're increasing that 125 to probably like $1,000 every other week, it's not going to really help you as much as you might think. Because again, you got to think like, in order to make, let's say there's an ETF, right? That we're going to discount cover call. We're going to discount the newer cover call ETFs that have 100% distribution rates, because I don't think that's sustainable. I don't think they're always going to pay this out. So let's discount that, and let's go with something really, I want to say realistic. Some may disagree with me, but we'll go with 10%, right? We'll go with 10%. So if you're investing into a cover call ETF that produces 10%, or any ETF that produces 10%, you would need a sizable amount of money to make anything reasonable. Let's say $500,000, that would give you $50,000 a year, right? Just off 10%. Now, if you start investing into these higher yielding products, like let's say 50%, then you only need $250,000 invested into this ETF or product or instrument in order to make that same $50,000, right? I think that's the math. I think that math's, I don't know. But yeah, you have to think of it like this, but you also have to consider the risks associated with investing into these other instruments, because they don't always go up, and their dividends could be cut, their distribution rates could be decreased. All these things, all these factors come into account. So you just have to remember to keep that in the back of your mind. There's like 100 different ways to skin a cat. So I hope that addresses that. I have to get off here in the next minute. I'll answer this last point. So BR Supreme says, hypothetically speaking, if Gabe sold his $400,000 home and invested in an SEHD, he would only be making $14,000 a year. Yeah. That's about it, right? Yeah. $400,000. I think SEHD is yielding around 4 to 5% last time I checked. But yeah, he would be yielding about that much, so is it worth it? I don't know. You tell me. What do you think about investing in growth types for 7 to 10 years and then just sell off and reinvest everything in dividend based types? So that's the conventional wisdom, right? And that's kind of what a lot of people will do. They'll get like an index fund, like an S&P 500 to $1 million, and then just withdraw. It's called the 4% rule, right? I hope you have a piece of paper, but it's called the 4% rule. If you look that up, it'll kind of explain the math and the theory behind, withdrawing 4% a year from your, S&P 500 index of some sort. That's one way to do it. The other way is, yeah, you could, but you have to think of the tax burden that's going to come with that, right? Let's say if it's in a Roth IRA, you could be able to do that, right? That is an option. If it was in a taxable account, if you sell out of everything and move it into dividend paying stocks, you're going to have to pay taxes on that sale, on any capital gains. And then if you're going to move it into, dividend paying stocks, you're going to be paying taxes on the dividend. So again, this is all stuff you have to keep in the back of your mind. All right. So that'll do it for me, guys. I really hope you got a lot of value, a lot of nuggets from this stream. We covered a lot, and I really, really hope that you guys are able to take something away from this. All right. So again, without you guys, there is no stream. So I always appreciate those who do join and comment, or even, smash that like. If you're a new subscriber, appreciate you subscribing. I do these lives every other day, or every day rather, Monday to Friday, 8 p.m. Eastern Standard. So I will see you guys all in the very next stream. You guys have a great night or the rest of your day.